tax planning, individual tax planning management, and business consulting. But today we have picked the topic of co-ops. I'd like to introduce to you our panel: Todd Heel, Mike
Elliott.
I'm sorry, Todd Helly, Mike Mesh, and Kim Vine. Thank you so much for being here.
Thank you. Thanks for taking time out of your beautiful day here today to come and listen to us. Hopefully everyone's able to find a seat. If not, I think there's some standing room in the back. Sarcasm for you. No, I like a small group though. I think this will be good. We'll be able to answer all of your questions. We should have plenty of time at the end. Terry Lockridge & Dunn is my firm, and we have been around since 1978. So this November, I think, will be our 33rd year in practice. We focus on tax and financial planning for businesses and individuals. And we also have several niche areas of expertise. One of those happens to be real estate transactions. Todd Helly and Kim Vine both have extensive experience and focus in the area of real estate. We have clients that range from landlords, developers, and a lot of realtor clients as well as our founder of our firm owns 60 to 70 properties. So we, unfortunately, we get to do his tax return every year, which is pretty fun. But first up, I'll introduce Todd Helly. Thank you.
Thanks for giving me the opportunity to speak. Any of you guys know or familiar with the residential co-op? Very low. Okay. They started in the late 1800s. They started in New York City. People could not afford to buy single-family homes. They could go in as a group of people and buy an apartment building and own a unit in the apartment building. But essentially, what happens is the building is put into a corporation, and each of the resident owners owned a unit in that corporation. It's gone on for along like that for a number of years. And there's a lot of these in East Coast, New York, the large metropolitan areas. Now, with some tax law changes and some code sections and some rulings that have come down, we can apply that same logic to what you guys refer to as commercial apartment buildings. And if you have a 4-plex or a 12-plex or a 40-plex that you own and lease out to other people, most people think of that as a commercial property. It's generating income for you guys. The advantage of the co-op now is, and the whole reason you'd even consider it, is the property tax savings. Right now, that commercial property that you're thinking of is taxed at commercial rates. There's no rollback. You pay whatever it's assessed for, you pay the full property tax. Once you set up this cooperative, it allows you to get residential treatment. You get a residential rollback just like you would on your house. Usually that's in the 40 to 45% range. If you got a $2 million building, you're paying $120,000 in property taxes, that just saved you $55,000 to $60,000. That's a substantial saving. And that's not once and you're done. That's every year. That adds value. I mean, not only do you save the property taxes, but it increases the value of your property. I mean, if you're going to a bank to get a loan, what do they look at? Debt to income, right? Or capitalization rate. If you can cut your property taxes by 40%, you just added that much more to the bottom line. Yes?
Not to interrupt you, Todd, but go along those lines of thinking, if you have a property, say it's worth $80,000,
Yes.
and then you go into a co-op, and you set this thing up as a co-op. Now all of a sudden you've got property that is worth $40,000 a unit, and you go down and get this thing valued at the tax office.
Right.
Now they're saying, well, now this building is worth $160,000. Wouldn't you be right back where you are with an $80,000 valuation?
In most cases, because it's still an entire building, they haven't, I mean, around here, they haven't increased the value of those properties. You're much more likely, if you condoize or minimize the units, that each individual unit can be sold separately. I mean, there's a deed for every single condo unit there. So you can sell, if I have a 40-unit building and I have somebody that wants to live there and wants to buy a unit from me, I can go ahead and sell that. There's more buyers in that market. So that condos have been assessed a little bit higher, but it hasn't been a 100% increase in value. I mean, the property tax savings aren't going to increase the value of the property 100%. So even with a 50% rollback, you're still farther ahead. But my experience from what I've seen is the commercial co-ops have not gotten or not had a huge increase in assessed value. Just because you still have to, when you sell it, you still have to sell the entire building. There's fewer buyers for that large building. So those are the advantages of doing a co-op. The disadvantages are all the administrative work. You have to set up a corporation, you have to file articles, you have to file a tax return every year. My partner Kim Vine will get into the specifics of all that, but that's annual work that you have to do. I mean, yes, it's a nuisance, but if you can save 45-50% in the property taxes, I have one client right now that's looking at co-op in a building that's going to save their property, save $70,000 a year. He can afford to pay me to do a tax return for a number of tax returns. If you have a duplex, whether it makes sense to do that or not, I mean, you have to weigh the economic opportunity cost. If it's going to save you $500 in property tax or $1,000 in property tax, and you got to jump through the hoops of filing a corporation, paying to have somebody do a tax return, file the minutes, it may not be worth it. But if you have a larger property, 12-plex or 24-plex, those things are prime candidates for a residential co-op. The differences between the co-ops and condos, I want to make a broad statement right now. If you have a newer building or that is up to code, co-op is not the thing you want to do. If you can get a building to be put into condos, that's what you want to do. But the reason why a lot of properties don't qualify, it's too cost prohibitive. If you have a 30-year-old building, to put a property into condominiums, it has to be brought up to code. So you may have to put a sprinkler system in. You may have to put an elevator system in. Those things are very expensive. If it's going to cost you $500,000 to bring the building up to code, how many years do you have to own it to save property taxes to offset that? And factoring in time value of money, it may not make sense. So you want to know, you need to weigh everything. This is going to be an ideal situation for a 25 or 30-year-old building that you're paying high property taxes on, and you can get it rolled back to residential rates. Okay? Talked about the disadvantages. One other disadvantage is there's not a, when I asked you earlier about who knew what a residential co-op was, not very many hands went up. So at the end of the day, when you sell this property, the buyers are going to know, you don't own real estate. You own a certificate, almost like a stock certificate, in a corporation. The buyer's like, I do real estate, I don't do stock. That's one thing you're going to have to overcome because, I mean, we can do these speaking engagements and try to inform people, but we're not going to find everybody. So you may have to spend some time educating a potential buyer as to the validity of a co-op. Okay? A condo, every single parcel or every single unit that you put into a condo has its own deed. Transferable, makes a lot of sense to everybody in this room. With a co-op, there's one deed. The co-op owns the entire piece of real estate. What you own is a certificate of ownership in the cooperative corp itself. The thing that you have to educate people on is the fact that with a cooperative, you issue or you prepare proprietary leases. And Kim will get into that. But essentially what it says is, I'm transferring a building I own into a corporation. I am in turn going to get a long-term lease, 30, 40, 50 years. It's a proprietary lease to lease from the corporation, and then I sublease it to the tenants. So as far as the tenants are concerned, nothing's changed. And there's just ownership change. Okay? And with the court rulings, with the court ruling that just happened, we have something we can hang our hat on now that says the co-op is residential property. The Jasper County Board of Review, there's the Krug case where the taxpayer went through all the hoops, filed the articles, transferred the real estate into the corporation. And the Jasper County Board of Review said, we're not going to classify it as residential. You're using it as a commercial apartment building. You're leasing it to other people. You're not living in it. So we don't think you should get residential treatment. And initially they won. But the reason why they won is because the court said, or the Board of Review said, you didn't dot all your I's and cross all your T's. They came back, went to the Court of Appeals, showed that they had everything in line. They had the corporate documents, they had the minutes, they had the transfer of the deed to the corporation, and then the taxpayer won. The courts, and then the Board of Reviews took it to the Supreme Court. The Iowa Supreme Court ruled on it at the end of July. And what they said is, based on Code Section 499A of the Iowa Code, it looks at the clear definition, not the actual use. The County Board of Review, the Jasper County Board, was saying, substance over form, I'm using this as a commercial property. What the Supreme Court said was, we don't care what it's used for. It states in the code, if you have a cooperative corporation that has residential living quarters, that's a residential property. They can't challenge that anymore. And that's what we have to hang our hat on now. We didn't have that 6 months ago. And what was our next slide? The requirements regarding city government. Just to give you a flavor as to what's going on, Cedar Rapids, Lynn County, Dubuque, Waterloo, they haven't been contesting these. If you've gone through the steps, they're just assessing it as residential and giving you the rollback. Marion, the city of Marion, even though it's in Lynn County, because it depends on where your property is located as to which entity you have to check with. I mean, if you have a property in Marion, they've been sticklers and trying to fight tooth and nail to get it reclassified as residential. So when you're going to check with your attorney, I mean, if you're in Western Iowa or wherever you're from, you have to check where your properties are at to see. Well, with this court case, it's just a matter of going through the formalities. Yes?
Would government be able to revoke your co-op status?
I don't think so, not with this new court ruling. Obviously, that's a question for the attorneys. But, I mean, legislature can do anything. I mean, they can change the code if they want. And that's one of my slides later on. I'll bring it up now. Don't worry about it, Attorney. There was talk of a commercial rollback. Governor Branstad and the Republicans talked about rolling back commercial property tax rates, and they were going to phase it in over a 5-year period. That did not pass. And the likelihood of it passing, in my mind, is not that great. I mean, given the economic situation we're in right now, and everybody's looking to cut spending, the last thing they're going to do is want to cut property taxes. So it may happen, but it may be 4 years down the road. If you can get something done now and get this tax savings at least for several years, it may pay for itself to do the co-op now. Before getting started, and I touched on it a little bit, know what your goals are for that property. If you are planning on selling the property in a couple of years, it's probably not worth going through the hassle. Because by the time you're going to want to talk to your attorney in the next month or so, because you have to have the paperwork drawn up, signed, finalized, filed with the Secretary of State to have it set up as a corporation prior to January 1, because that's when the assessment happens. But the assessment that happens on January 1 doesn't affect your property tax bill until September 2013. So you're still a year and a half out before you even see any savings. So if you're planning on selling it in 2 years, this is not something for you.
Wait, can you repeat that? You have to get the paperwork in by when?
You want to talk to your attorney. If what we're saying makes sense to you right now, essentially you want to start talking to your attorney now.
Okay.
You want that paperwork done, finalized, recorded, so that on January 1, the corporation owns the property and not you personally.
And then you would see,
And then,
you would
well,
take
then
all that
it would get assessed. I mean, they would have an assessment, they'll value the property. The assessed value is not going to change a lot.
Right.
But the rollback, when you get that property tax bill next June or next January, so for due September of 2013, it would have the residential rollback factored into it.
Okay, thank you.
So you're really not seeing that savings until
Right.
then.
Okay, got it.
You're only saying that we need to do that now if you wanted to see that savings in
In 2000, right.
2015.
Right.
We could do this next year.
You could do it
There's no
now,
reason.
Prolong.
but if it makes sense to do it, then we do it now. Because every year you wait is just another year you take too much property tax.
Well, taxes are assessed in arrears, so you have 18 months till you see the savings, right?
That's right.
That's what
it
it's saying.
is. Yeah.
Okay.
You don't see that tax reduction until September of 2013.
Oh, okay.
If you get it filed now. Yep. All right.
Next up, Kim will talk a little bit about the operational considerations, tax filings, et cetera, that you have to do on an annual basis.
Good afternoon. Well, let's make sure you all can hear me. See me, first of all, but hear me too, I guess. Yeah, now that Todd has talked about what a co-op is, kind of how it compares and contrasts to a condominium, and why you would be interested in considering a co-op for operation of your existing rental activity, I'm thinking you're on the edge of your seats wondering how you sign up for this and what's the next step. Okay, so that's what I'm going to talk about, is the operational considerations. And I've kind of broken my discussion down into 3 sections. There's the stuff that you're going to have to consider right up front, some structural setup processes, and of course there's going to be a cost associated with that, primarily legal fees, but you're also going to want to consult with your accountant to make sure you're not blindsided by tax issues, which we'll further discuss here in a minute. Also, we want to talk about the ongoing transactional hoops you have to jump through to help legitimize your co-op. And then Todd did allude to that there's going to be some additional tax filing requirements because you are setting up a whole other legal entity, which the IRS is going to be looking for a tax return from. And we'll talk about just real straightforward to the implications of that as far as tax filing goes. So the first step, establishing the actual structure. A corporation will need to be set up. It's specifically a cooperative corporation. Your attorney will create articles of incorporation for you. They'll be filed with the Secretary of State. It'll also your attorney will also set up bylaws, because any corporation, legitimate corporation, should have bylaws, and you want to do everything with your T's crossed and your I's dotted. So you'll want your bylaws in place. Sir?
Not to interrupt you already. Are you saying that each building needs its own corporation, or just a corporation you can keep including buildings into?
Okay, good question. I would suggest a separate corporation for each building, for each property or complex, because that way, if you decide you want to sell just one property, you're able to sell your ownership interest in that condo without having to dispose of anything else. Gives you more flexibility if you have a separate corporation set up for each of your separate rental properties. And each corporation is going to have some sort of ownership certificates created, just like a stockholder in effect. And cooperative corporations have a special requirement that you need to have at least 2 owners. Any other corporation you can get by with 1 owner, but cooperative corporations need to have 2 owners. And so if you're wondering, currently, well, I just own this property on my own, how do I get another owner involved? Well, it's usually not a huge hurdle to get over, because you can, if you're married, you could potentially use a spouse as the second owner, or you could use a single member LLC in which you're that single member. So that's a fairly easy workaround. Another important piece of documentation that is created up front is something called the proprietary lease, and this is unique to cooperative corporations. The proprietary lease, remember, the co-op owns the building, because you're going to do a deed transfer, that's also up on the list, but the co-op owns the building. It's going to lease it to you on a very long-term lease, and the provisions of the lease are very liberal. You have all of the same, pretty much all of the same rights to do with and make decisions with regard to that property that you would have if you just owned the property outright. So then, of course, you're the person who then subleases to the actual tenant. Another incredibly important step, and again, if you want the January 1st assessment with the rollback, you would need to accomplish this by January 1st, is getting your property actually deeded over into that new entity, into their name. So, and usually with the deed transfer also goes the mortgage. So you would need to work with your lender on getting that mortgage transferred, because usually there's a due on transfer clause. So if you're transferring ownership in the real estate, you've got to deal with getting the mortgage transferred also. And it is possible to keep the mortgage out. We'll talk about that later, but something will need to be dealt with regard to the mortgage. And then the entity will also need to create its own bank account and have a federal ID number for the bank account, as well as for tax filing requirements. And we'll talk about why the co-op needs a bank account. There's going to be certain funds that come into and go out of the co-op. And we'll get to that in the next slide, actually. Okay. So how does having this co-op in place, this other player that wasn't there before, how does that affect the mechanics of how you operate your rental operation? Fortunately, not much. There's a couple of extra steps that you're going to need to take, but they're more just hassles than they are, a serious hurdle or problem. The tenant will continue to write their rent checks to you, or if you happen to be an LLC that currently owns your rental property and it's your LLC that's going to be transferring the property to the co-op, it would be your LLC that the tenants, whoever they've written their checks to before, they're still going to write them. If there was a management company involved, that all just still stays the same. Tenant pays you. You pay most all these same expenses that you had paid before, except for insurance, property taxes, and your mortgage payment. It's important that the co-op, as the legal owner of the property, make those payments. So you, instead of writing a check directly to the insurance company or to the county or to the lender, you write a check to the co-op, and the co-op in turn will make those payments. So it is an extra step, but it's no net effect on your cash flow. You're just funneling those payments through the co-op's checking account, through the co-op's books. When it comes time to put on a new roof or re-side the entire building or make some sort of permanent capital improvement to the property, that's another expenditure that you would want the co-op to pay for, because again, the co-op is the legal owner of the property and it should make that kind of expenditure. So the co-op will need to assess you, just like it assessed you for the mortgage payment and the property taxes and the insurance that it has to pay. It would make an assessment to you, so you fund into the co-op the amount it needs to actually make that expenditure for that capital improvement. I have a note on this slide that the paper trail is important, and that just refers back to that Krupp versus Jasper County Supreme Court case where it was very important that the co-op followed all of these steps which may otherwise seem kind of pointless because you're still making the same insurance payment and mortgage payment, property tax payment, but you're just having to write the check to the co-op, and the co-op writes the check to the lender and so forth. But those steps are important. I think that case points that out. The next slide has an example about the actual flow of funds. I mean, just putting numbers on what I just talked about. Let's say you have a property that brings in $10,000 a month from tenants. They continue to make that payment directly to you as the co-op owner. You know, you own those ownership certificates in the co-op, and you have that proprietary lease. So the tenant continues to make the payments to you. Let's say you incur $3,000 of utilities and upkeep and miscellaneous expenses. You will continue to pay those out of your own rental checking account. And then if the property taxes, mortgage interest, and insurance are $5,000, you would write a $5,000 check to the co-op so that it could then pay those expenses. And in this example, this is a property that had the $2,000 positive cash flow this month, and that just stays in your own rental checking account, accessible by you. So there's no net effect on your own personal cash flow. It's all just mechanics in terms of how those certain bills get paid. Oh, and this also, I guess, just kind of points out the fact that the co-op is kind of a net zero entity. It just takes in the amount that it needs to be able to cover those expenses that it should pay. Those definite 3 expenses plus capital improvements. So then as far as the tax filing goes, the co-op will need to file its own tax return. In fact, the IRS has a special form for housing cooperatives, Form 1120C. And just like we kind of just talked about, the income that the co-op reports is going to be called assessment income. It's going to be that money that you funded into the co-op so that it could pay certain expenses. And then the deductions on the co-op return are going to be the expenses that it paid, the property taxes, insurance, and mortgage interest. And in addition, the co-op will be able to take depreciation, because when you transferred that property into the co-op, it now has a property that has some basis that it can continue to depreciate. So bottom line, on the co-op's tax return, there should be minimal, if any, net income or tax to be paid, because again, the co-op is pretty much a net zero entity.
If you're transferring a property that's been depreciated out, does that co-op then get a whole depreciation schedule?
Not generally, not if you take advantage of the ability to transfer your property in tax-free. To do a tax-free transfer in, and I have some more discussion on that coming up, the co-op would have to take over your tax basis. So that's the kind of thing that you're going to want to know going in. You're going to want to look at those kinds of things. What kind of basis do we have on the property? You're going to be sitting down with your accountant to talk about those kind of things before you pull the trigger on this. You as the co-op owner, your tax return, if you're an LLC, you'll continue to file the rental schedule within your LLC or your partnership tax return, Form 8825, or if you're 1040, you'll continue to file your Schedule E for your rental activity, and you'll continue to report the same rent income that you get from your tenants. You'll report those expenses that you pay, your utilities, your upkeep, and all of that. And you'll also get to report, as a deduction, those items that you pay for via your payment over to the co-op. So to the extent that the money you put in the co-op is used to pay property taxes, insurance, and mortgage interest, you get to continue to take those deductions on your rental schedule as well. So far everything's the same. Jim?
So if you're assessed for a new roof, you need to deduct it in your assessment as opposed to depreciating it?
No, you would still have to depreciate it. No, good question. It doesn't turn an otherwise capitalizable item into a current deduction item. You would get to depreciate it only because, remember, you don't own a building anymore. You own ownership interest in a cooperative corporation, but the Internal Revenue Code has a special provision that allows an ownership interest in a co-op to be a deductible asset. Depreciable asset, excuse me, is what I should have said. And when you make a special assessment payment into the co-op, it increases your tax basis in that asset, that share of ownership interest that you have, and therefore you can continue to depreciate based on how that money got used. So if it got used for a 27.5-year capitalizable type item, then you depreciate over 27.5 years. Your depreciation pretty much mirrors the same depreciation you would have had you just continued to own the rental property. So bottom line, I'm just trying to say, I've oversimplified here a little bit about the tax issues, but yet at the same time, it's really not rocket science. You're pretty much left in the same tax position you would have been in had you continued to own the property. Bottom line, that's what I'm trying to get across, is that it's not a huge tax effect by using this cooperative structure. When it comes time to sell, remember, you don't own the building, you own an interest in a co-op. So that's what you're selling, is an interest in the co-op. And what consequences does that have different than if you had just sold a building? And again, none. The sale of those co-op units get the same kind of capital gain benefits as if you had sold a building. Same depreciation recapture issues would apply on the sale of your co-op units as if you had sold the building itself. Same potential ability to do a 1031 exchange, even, because those co-op units, due to the proprietary lease that's in place and so forth, legally they're viewed enough like an interest in real estate that you can like-kind exchange into other real estate. But you want to be working closely with your accountant on those kinds of issues. The other thing on this slide is 351 transfer, and that just refers to the code section that allows an asset to be transferred into a corporation tax-free. Because let's say you have a building that's worth $100,000, but your tax basis in it is only $80,000. Absent Section 351, you'd have to realize a $20,000 gain just to get that into the corporation, treat it like you sold it for fair market value. Corporation would take on its purchase price as its basis, $120,000 or $100,000. You'd have a $20,000 gain. But fortunately, Section 351, which is commonly used, not just in this co-op setting, but anytime you're funding assets into a corporation, where you just have basis carryover and no taxable gain on the actual transfer of that asset in. I have a note there as to an alert, because we don't want you to be blindsided by a situation where your tax basis and your rental property is less than the debt on your rental property.
Oh, yeah, can you explain that?
Yep, in fact, I can walk through an example, much like that. Okay, on the next slide. And this, because this is not an uncommon situation, especially in an older building where you've been depreciating it for many years, and so your tax basis is going down, but maybe you're not paying off your debt that quickly, or you've been borrowing some on the equity of the property or whatever. So let's just use an example here of a building that you paid $100,000 for initially. And over the years, you've taken $40,000 of depreciation, which brings your tax cost basis down to $60,000. That's the part of your cost that you haven't yet deducted on your tax return. So you're going to transfer that asset with a $60,000 basis into your corporation. But let's say you have $85,000 of mortgage debt on that property. When you transfer that mortgage debt, you're going from being the person who owed the lender $85,000 to being a person who now owes the lender nothing because somebody else owes the lender $85,000. That's treated as though you got $85,000 of consideration because you've been relieved of that liability. And so it's as though you sold the property to your corporation for that liability, which it took over on your behalf, $85,000. It's treated like a sale price, against which you can deduct your adjusted basis in the building, which is $60,000 in this example. But we're still left with a $25,000 taxable gain. There's some different things that you can do to deal with this gain. First of all, you can just recognize maybe the gain isn't really that bad, and the taxes that I'm going to have to pay on that gain are minor in comparison to the property tax savings I'm going to achieve by doing this. Or you can look at your tax return, talk to your accountant, and see if you have some passive loss carryovers that might offset this gain. If you've had losses on your rental properties, there's a decent chance you might have some passive loss carryovers if you haven't been able to use them all every year. And this gain would be considered passive and able to use those loss carryovers against. But if the gain is just too large and you can't offset it with passive loss carryovers, it's just prohibitive to recognize this gain. You still have another option, which would be to just simply not transfer the mortgage into the co-op. And if you did that, you would need to work closely with your lender because, of course, it's, I mentioned earlier, probably a due on transfer clause in your debt that says if you're going to transfer ownership in this building, your loan's due. You need to pay us. So you need to work with your lender about possibly substituting the collateral to them rather than them holding an interest in, rather than having an interest in the building as collateral. They would possibly take an interest in your ownership interest in the co-op. They would take that as collateral. Attorneys tell me that they can get to the bank. They can get the bank to the same place in terms of its protection upon default by even leaving the mortgage out. They kind of call it having an outside mortgage, being outside of the co-op versus having an inside mortgage. So there's ways to deal with this fairly common situation of potential taxable gain on the transfer in. Let's see, I guess I want to just make sure. We're going to have an opportunity for questions, and Mike's going to say a few words quickly just to kind of summarize some things, and then actually Mike has agreed to answer all your questions. So, feel free.
That's actually not true. I am going to summarize, though, everything just to kind of what we wanted you to take away from this presentation. Essentially, this Krupp case has really kind of solidified your ability now as an Iowa multi-unit residential property holder to cut your property taxes in half. And as a side benefit, increased cash flow, you can realize an increased value in your properties potentially, and also potentially your borrowing power on these properties as well. So there's plenty of good benefits of this, and really the costs are jumping through a few hoops on an annual basis, which really, it's a matter of you getting used to doing that. It's not that difficult, and we've helped teach our clients how to do that, you know, in an hour, essentially going through the process of what you need to do. It's not right for everyone, though. There's a multitude of considerations, you know, that might be specific to you, whether that be the basis in your property, your holding period, your expected holding period for this property also comes into play. So make sure you talk with your accountant, and we have plenty of accountants who would be willing to talk with you about any of this. And then you need to get a good attorney as well to work with you on drawing up these documents. And then I'll just say again, I think it's been mentioned a couple times, but in order to realize the benefit of the assessment that would come September of 2013, you want to get this all done prior to January 1st of 2012. And from the attorneys we've talked to, it takes, you know, a month to a month and a half to get everything done.
Do you have to have all this stuff done before first of the year? Could you do it like in the middle of the year? Or it's,
you could do it.
You didn't do it this year, you want to do it next year?
Sure, you could do it anytime during the year, but the assessment happens January 1st of each year, so you're just going to wait longer, is all. So we'll take questions now, and I'm up here to kind of relay the questions. So. But I think it's small.